Well, we move into a quiet period for financial markets, but as traders, we adapt to the surroundings that we're given. We've got the VIX trading at 13%. We've got gold trapped in a range of 23.50 down to 22.80. We've got the dollar, which is a little bit choppy at the moment, but we look forward at the catalyst that could cause some potential volatility and see us trade out of this bit of a slumber that we seem to be finding ourselves in at the moment. It's time to get in front of the screens. This is the trade-off. Hi, I'm Chris Weston from Pepperstone, and I'm going to be joined in 2 seconds by Blake, the vol whisperer, Morrow from Forex Analytics, and we're going to be discussing all the factors that are going on in these weird and wonderful markets, the low volatility, what could cause us to break out of this slumber, the different catalysts that could move us. So, Mr. Blake Morrow, please come into the programme. Obviously, very low volatility. We're seeing the VIX 13%. We'll talk a little bit about that vol in a second, but what are you sort of advising traders at the moment? Is it more about taking that stop loss in a bit? You can take a bigger position, spend a bit of time away from the screens. You don't have to be so cute with your positions. How are you sort of adapting to these kind of low ranges or lower ranges, lower volatility environment?
Well, since you call me the vol whisperer, I'll just say this: I see dead people. That's The Sixth Sense, guys. If you ever saw the movie, it's a great movie. Anyway,
darkness just comes over Blake now.
Volatility, it is low and it's depressing. We are definitely in a range trading environment. I think a lot of us are asleep at the wheel. Come European afternoons, once Europe's gone home for the day, it's like in the US we're just kind of waiting. But we've got a lot of things coming up that could really spice up the markets. And it's not just FX. I mean, you guys look at equities. We're going to talk about equities. Look at other markets. There are things happening, but whenever the market is very low, you just have. There's an old saying: "Don't short a dull market."
Don't short a dull market. But when you sit there and you have to try and go into individual stocks, names like Uber, to try and find some movement, because that sort of fits in your strategy, then things are tough. But I wanted to discuss that volatility as a top subject today, because I think it's really, really, really important. So let's go into topical thunder. Yeah, Blake, we've got VIX trading at 13%. We have been lower this year, but we are at the 5th percentile in the S&P implied vol for the last 12 months. Bond volatility is still pretty low at the moment. You've seen the 10-year sort of find this nice little range at the moment. It feels like a nice place, and also on a real rates has found a kind of a sweet spot. That lower volatility is sort of manifesting across the different asset classes at the moment. When you look at volatility, you tend to look at it on what we call a close-to-close basis. What are the percentage changes on the day? And implied volatility, which is the VIX, really takes its cues from how volatility is realising, which again is those close-to-close. But if you, as day traders and as short-term traders, we look at the range that's happening. So I like to look at the ATR, look at the sort of ranges we're seeing, and they've been coming down across asset class as well. So we adapt. We may be taking our stop loss up a bit. We can increase our position size. We can be away from the screens a little bit longer. First, 2 questions. I know I'm killing time here, but 2, how are you adapting, as we talked about? But then, what is the single biggest factor that causes us to break it in higher in volatility?
Well, it's going to be event driven, I would assume, and it's got to be, whether it's a headline from the Middle East or whether it's a piece of key economic data that's going to move the market. Because obviously we're getting past earnings season, and Disney getting pummeled and Shopify getting pummeled, it doesn't do anything. So we've got to wait for some economic data.
Well, I say that, mate, just sorry to jump in, but the NVIDIA numbers coming out on the 22nd of May, I mean, they are the options market's implying a 10% move in that stock on the day of earnings. So, I feel like that could be a volatility event there.
It may be, but it's interesting. You ask about like what is a strategy. I mean, when you have the euro trading in a 35 pip trading range, you can take bigger positions, keep your stops tighter. It's a better way to risk manage in a low volatility environment, but adhere to your stops. And I think that's the most important thing, especially if you're in a bigger position. You have to realize that, if you get stopped out, you got to get stopped out and shake it off, lift up your chin and move along. But if you're looking at volatility like the VIX, on the S&P, a lot of people, and I know people get irritated when you pull up a chart and then you pull up VIX and you try to do some technical analysis. Fact of the matter is, we're down near some pretty critical support, but we could actually drift another 10% lower in VIX, still be within a support level, and we could be doing this for a few more weeks. I hope that's not the case. We are in the risky area of potentially bouncing in volatility, but again, I think we need economic data or an event.
Well, you just need people to stop selling volatility. But they have. I mean, I think there's very limited reasons to be doing so down with the VIX at 13%. 1 month puts are trading at a 2 vol premium to calls. So, yeah, it's not really giving too much there either, to be honest. So, yeah, you need realised volatility to pick up. And that means you need to see higher close-to-close prices. We've just seen today the S&P close completely unchanged. That's not going to do volatility any good. So you need to see 1% net changes on the day, and then you'll see volatility rise. Maybe that comes from the CPI print. We'll cover that in a second.
Maybe it does. All right. Well, let's talk about equities because, like I just said, never short a dull market. Now, that doesn't necessarily mean that's going to work all the time, and especially if you're in a bear market. If you're in a bear market and volatility is low, I've seen markets drift lower, and same way they're drifting higher. I've been in bear markets where they just drift lower and it feels like there's no stopping markets to going lower. We are in the exact polar opposite right now. And we're seeing equity markets within, a stone's throw from highs in the US. But what's leading the charge, Chris, and I know you've been looking at this, is you got the German DAX that looks like it's about ready to break out. You've got the CAC 40 that doesn't look so bad. You've got what's another the FTSE. FTSE's ripping. Like we spent a couple of years not doing anything, and all of a sudden now all your relatives in the UK are getting rich. I mean, what's up with that? But
they're all driven by the banks. It's all Anglo-American aside because they've had a takeover bid. But you've got Barclays, which is ripping. NatWest, St James's Place. I mean, they're just since the move that we saw on the 16th of April. UK banks are really going nuts at the moment. So I mean, that's a ripping. I mean, I wouldn't necessarily be buying at these levels, but the FTSE's been absolutely. And then obviously you got the Hang Seng as well, which is now cooled off a bit, but that's been driven by Tencent, Alibaba, and that market's been ripping as well. So S&P has cooled off a bit. Dow's up 6 days in a row, though.
Yeah, Dow, yes, and the Dow actually looks pretty good, and it feels like a relay race with equity markets, doesn't it? It's like, U.S. equities, we're done. Pass off the baton to Europe. They pass off the baton, or actually it was to China. China passes off the baton, or Asia passes off the baton to Europe, and it seems like it's going around and round and round, and you're seeing money just shift from location to location. My question to you is, how much further can they go? I mean, we especially looking at the FTSE. I mean, we just expanded past 127% extension of like a huge range. Still looks good.
Well, it's like the ASX. That was outperforming recently as well, and got a bit of a leg up after the RBA's more neutral statement, but got into 7,800, and it seems to have found a lift. And I was comparing being long the ASX to supporting Arsenal, the football club, because it's in a nice moment at the moment, but at the end of the season it's going to end in heartbreak and tears. So I think that's it. But I really want these markets to go to all-time highs. I mean, I want to see the NASDAQ push up another leg higher, and I think that takes NVIDIA to do it. But the flows at the moment seem to be taking place in those European markets, and I think pullbacks are a buying opportunity there. I think that still seems to be the place because earnings in Europe have been pretty strong. The UK has been a good place. We'll have to see what happens with the Bank of England. It'd be nice, I think, will a dovish Bank of England be good for the FTSE, or will it be bad? We'll have to see, because the banks potentially could do quite well on the back of continuing to be fairly hawkish. But that's where the flows have been. And so I like to buy strong and buy pullbacks in what's been strong, and I think they've been the strong markets. So we'll see what happens going forward. But they follow the strength, follow the flows. Anyway, let's go into the central bank issues, Blake, because we are seeing that divergence continue to kick up, and I saw the Riksbank just cut rates 25 basis points. There's a call that perhaps they could have waited, but they've joined the Swiss National Bank, and the Swiss National Bank will probably cut rates again in their meeting in June. It's going to be a lively June. I mean, the ECB, we're pricing 20 basis points, or an almost done deal that we get a rate cut from the ECB in June. The Bank of England, we got that tonight, but they're probably going to look to cut in July, maybe a bit further out. They might cut in August, I think is the call for the Bank of England. Bank of Canada, they're going to be cutting soon. RBNZ, probably October seems to be the date the market's looking for. The RBA, we've still got a small hiking bias being priced in there. But how are you reading? Which central bank immediately picks your mind, and how are you playing that from an FX perspective?
Well, so from an FX perspective, first of all, I hear everything that you're saying, and some banks are thinking that the first rate cut from the Fed might be in September.
Yeah.
In an election year.
It's mental, isn't it? It's like the last meeting, the Fed have never cut rates in that meeting before an election. If they do that, you're just going to hear, "You're politicized." It will be deafening.
It will be deafening, and I was having a conversation earlier today about this whole situation. The funny thing is, maybe Powell will do it just to avoid having Trump reelected, so he doesn't have to deal with the wrath.
Will it affect the situation? But if he does it and Trump wins, he's gone, right? He's got to go.
Oh, he's gone anyway. He's gone. Powell was appointed by Trump, and he's still going to be gone because. He's going to find another whipping boy. I mean, that's just the bottom line. But
Mate, quick question. I don't want to go off the subject. What happens in America if Trump comes in and Robert Lighthizer comes in as his potential Treasury Secretary? I mean, he's talking about Plaza Accord #2 or something like that. I mean, that could be a crazy, crazy time for the US dollar.
I think both administrations, no matter which is reelected or elected, Trump or Biden, they're both out to get the dollar. So I think the dollar is going to trade a little heavier. Going back to your divergence trade, and I know we need to move along, but that's the thing that's got me about the dollar. The dollar hasn't really responded in the divergence trade, which does scare me. And it does make me believe that a lot of this is already priced in. So should we get a cut from that, let's just call it the ECB being the majority of the dollar index, or more than 50%, I don't know how much downside there is in the euro.
Yeah, it's priced in. You're right. But you got to look at those yield spreads. What takes, US Treasuries wider on a premium basis to bunds, and that causes it. But a lot of it's all priced in now. So, I mean, for me now, it's all about terminal rates and what's priced in further out the curve, and looking at. It's getting complicated for some people who don't follow rates markets very closely. But you got to look at what's priced in as the end goal, and look at it on a relative basis from that perspective. But let's move on to
Yeah. I'm sorry.
There you go. I was going to say, let's move on to CPI because
everybody knows.
Sorry, go on.
Everybody knows we record on two opposite sides of the world, so sometimes there's a little bit of a delay. So just bear with us. Anyway, let's talk about CPI. Let's talk about what could be a volatility event, Chris. It would be potentially the CPI. Now, I was scanning through the last month's data and all major economies, and just scanning around, looking around. I noticed in the US we had some export prices that were lower. India had some manufacturing data. You had Korea, maybe Germany and France had some economic inflation data that Canada, excuse me. But when you look across the board and you look at all the beats and you look at all the countries, G20, all the beats on inflation, whether you're talking about prices or CPI, producer prices, CPI, whatever it is that you're looking at, it's sticky. And so going into the CPI data, people are going to be looking for they're going to be looking for a hotter number. So the reason why I bring this up is because next week I believe is going to be a volatility event, and you're not going to talk to us until after the CPI. You're not going to see this trade-off show. You can see the European trade-off show, but not this trade-off show until after CPI. The reason why I mentioned that is because, as we were just talking about, the dollar has not really been responding all that well in this, in this divergence trade. But what I'm thinking, Chris, is what happens if we have a miss? And I think the dollar would be punished. Now, I know I just used up a lot of time, so we're going to have to go on a little bit, but beyond time. So what do you think here, the CPI?
Well, we've got core at the moment at 3.8%. The market is looking for that to just come down to about 3.7%. So they are expecting core CPI to pull back a little bit. But yeah, it depends on. I mean, the playbook needs to be extreme. So I think if we're to get above 3.9, and certainly if it was at 4%, that would be a big surprise. The dollar would rally. People would start talking. Are we really going to get these 2 rate cuts this year? And then the dollar rallies, risk assets come off. But you could see a nice relief rally in risk assets, equities. The dollar yen, dollar Swiss could come off, and high beta effects like the Aussie could work really well if we were to get a core number 3.6% or below. So yeah, I mean, I think it's clearly fine. Obviously, if it comes in line with expectations, we don't really know what's going to happen. The market will do what it wants to do, but I feel like it is something that the market will be looking at very closely. And if you look at implied volatility on individual dates over that over the 15th, which is the CPI number, the implied volatility in the VIX is S&P is at the high point 18%. So the market is seeing that as a volatility event relative to other days. So yeah, I mean, I just hope it comes out one way or the other on a more extreme basis, can kick some life into the market.
Me too.
So yeah, I mean, I don't care which way it goes. I just want to see some life in the market. That's the thing with volatility. You don't care really where it goes. You just want to see some life. But yeah, I think the extremes there. So a surprise would be 3.5% or 3.9%. I think that's where you get movement coming through. That's the playbook, in my opinion. Anyway, let's move on to that's the setup. Right, first one I want to bring up is crude, because we have had a bit of a reversal playing through. We talked about this one last week. We had the head and shoulders pattern, which was targeting $74 in WTI. And, we were looking like we were going down there. I mean, it was respecting the levels, had a nice bounce up into the yellow line, came back down. The former range lows came back down. Really nice breakout through the neckline. We thought we were going to go down to $74. We got about 77. The buyers stepped in on no real news that I've seen, and then got an extra leg up because we saw the inventory report coming out with a bit of a decline, a withdrawal in barrels. But then, that wasn't the key. It sort of came out in European trade. And we've actually seen just a close above the prior day's close after that lower. So we've seen a bullish outside day reversal playing through with price below that Bollinger Band as well. So the way I'd be playing this is buy stop orders above the day's high and look for momentum to take us back to probably 81, 81.50. It may not come, but yeah, that's why you use the buy stop orders on that. But have we reached a low here, Blake, or do you think we've got more downside? How are you seeing this?
I'm so surprised, Chris. You do not have your nice trend line that you had up there for like the last couple of times you brought up this chart. The fact of the matter is today, you're correct. We had a bullish outside day, but we actually closed back above that broken trend line.
Well, I took it off because I just wanted to see if you were alert.
Oh, I'm alert. And so we got a nice false breakdown and we got a bullish outside day. I think the odds are stacked up that we might get a continuation higher. How's the market going to read into that? I'm not sure.
I don't think they care, mate, to be honest. I don't think we're at levels market's concerned with crude going up or down, personally.
Yeah, I think you might be right. So, hey, I think everybody knows the risk from here, and I like it as a reversal.
I think, if you look at the gold market, which we'll talk about in a second, if it was to do with geopolitics, the gold market would be moving as well, which is moving sideways. But I think this is an idiosyncratic issue now. You trade oil on its own issues. I know we're looking first at the 1st of June. We've got the the OPEC Plus meeting as well to see, monitor the how production's going. That could be a catalyst. But yeah, I think I'd be looking buy stop orders above the day's high. If it breaks through there, you hope it keeps going. That's why you use them as momentum tools.
Awesome. Well, I'm gonna bring up my first setup, Chris, which is the German DAX. And Junge. Dang it! I'm messing it up. And if you're German, Junge.
Why don't you write in the comments and let him know how to speak your language properly.
Please do. Anyway, look, German DAX is threatening to break out. 18,651. You can see that as the previous higher, 650. And a break above that, we're going to be targeting it. This is what we call a butterfly pattern. If it's a butterfly pattern, it can go to 18,961 or 19,383, which would take us to the top of that channel. I know it's divergent relative strength. I get it, but relative strength is pointing higher and it's not overbought yet. So it can continue higher, get closer to 80, still be divergent. That means it's probably a decent short up there, But until now and then, it looks pretty bullish. How are you reading the DAX, Chris?
Yeah, I mean, I like these. I like the symmetry in these patterns, and I like. Yeah, I feel like if there is going to be a market that has further upside, it's going to be coming from one of the European markets. And I love the DAX. I mean, we've got 40 companies in the DAX. You do get more concentration. You get less diversification than you do with the S&P 500 and those markets. You've got some big innovative businesses there. So I think the DAX is almost like the perfect trading market along with the Hang Seng, because you get these really big moves percentage wise. They're not too crazy. So I think the DAX is just a really good trading vehicle when it comes to equity indices. So yeah, does this go higher? I feel like the risk is that this kicks on. Whether it gets to those levels is obviously yet to be seen. But they're targets that you can work with. So I like the charts. I feel if there's an equity market that's going to outperform, it's going to be these European markets. The CPI number, if it comes out lower than expected, then I think risk assets continue to melt up into June. So let's see what happens there. We'll see. Anyway, let's go into gold, because I think that's a really interesting one, because it's not interesting. I mean, you got to trade the market you've given, and we've got clients who are just specifically gold traders. They just want to just hone in on gold. It's 24 hours a day, great liquidity. It's cheap to trade, so people just want to trade that one, and therefore, you just got to trade your strategy within that. I mean, I don't like doing that myself. I like to find markets that fit momentum strategy or mean reversion, and it's the strategy, and the market comes to me. But people do just trade gold, and I think if you're just trading gold at the moment, you have found this nice range, 2350, 2280. We've seen Shanghai trading volumes coming down. The Chinese have been big traders of gold recently. That's been one of the drivers. But the volumes have dissipated a little bit in the Shanghai futures. Gold implied volatility has come from about 18% on 1 week to 13%. The RSI, you can see, is mid-range. Bollinger Bands are coming in. It feels to me like we continue to range trade this. That seems to be the trade up until probably next week's CPI. What do you think?
Well, I like it. And let me just put it this way, from left to right, the chart moves higher, from left to right. So I would approach this range with more of a bullish bias. So if you can get it down below, 2280 or so, somewhere in that neighborhood, I think those are the levels that you want to be buying. Even see if you can get somebody to create you a false breakdown. You get a break below those lows, break below the range lows, and a pop back up. That's your time to go long. So I think trading this again from the long side is the way. And plus, you don't want to be stuck short on a geopolitical event gone wrong that you and I have no control over. So really it seems like right now the way to play it would be to the upside, but I like the range, and I think it's succinct pointing that out.
Play the range. Yeah, I think we get if we've got a move just below the bottom end of the range, just don't buy immediately, wait for the flush out, and it'll kick back inside the range, in my opinion.
All right. Well, my final setup for everybody here is going to be the Kiwi. And, some people say that Kiwi can't fly, but I don't know, Chris, this Kiwi looks like it might want to fly. And I love the chart. I love the setup. And let me tell you all the reasons why I love the setup. First of all, that's a bullish flag or pennant, depending on how low a retracement is. If you just looked at the last daily candle that just closed in North American trade, based on the time that my charts update and the feeds that I update, we got a bullish hammer. And you can see just above us is the 200 DMA. That's in red. Now we're kind of skating across the 50 DMA, which is the orange, but I'm more concerned with where the channel's at and the 38% retracement at. That all comes in right around 60-40 to 60-50, 60-50 being the 38% retracement. What I'm trying to tell you is I think Kiwis can fly on a move above the 200 DMA or above that 38% retracement. So Chris, you live in the area. Can Kiwis fly?
Well, I think the Aussie and the Kiwi probably do the same thing, won't they? If they're going to be, if this pair's going to break out that range, Aussie's going to do well. Kiwi's going to do. Mech's probably going to do quite well. It'll probably be a dollar move that drives this more than anything else. So yeah, I think we're looking ahead at that CPI number, and you might get a bit of chop in the short term in these pairs just ahead of that. But yeah, I mean, you're kind of making a play on it being a weak CPI. If we get a weak CPI, then I think the US dollar yields probably trade a bit lower, and risk currencies do well. You're probably going to see equities moving higher. So that would be the trigger, and it would it would take Kiwi dollar down. So I can give you the fundamental reasons, and you probably want to see a bit more outperformance from the Hang Seng after it's pulled back a little bit. But if we can see Alibaba and Tencent kick higher, then the Hang Seng goes higher, and that will probably lift some of these Antipodean proxies as well. So I can tell you why it might go there. Let's see if price, obviously price is true, and that's what we trade, right? So we'll see what happens there. So that's what we react to. But I can tell you why I think it might go there. Let's see how the data runs out.
Awesome. And Chris, I just want to mention on Sunday evening, which would be Monday morning for New Zealand and for you guys, there's New Zealand inflation expectations. Looking for that maybe to be a little bit of a kick. We'll see.
When's the milk auction?
I don't know, but I was looking at visitor arrivals. Just kidding.
Mate, you should go there. It's a beautiful place.
I would love to, actually. So
yeah, there you go. Anyway, let's go to play of the day. I'm going to go for a bit of Bitcoin. If we have a look at, we're in a down channel at the moment. We've seen a few days now of lower highs and lower lows. Prices below the 5-day exponential moving average. Now, I will say for the Bitcoin heads out there who are hodlers, I do think that we are going to go down to about 58,000. For anyone who follows the scene closely and has a look at realized price, the short-term realized price for Bitcoin is around 58,000. That is always, it's typically sort of a psychological level where a lot of people have been buying. And that's kind of the realised price effectively. So yeah, I think 58,000 is the target. If you get a bit of a dip below there, then I think that becomes a buying opportunity, and I think we'll start seeing this V-shaped bottom for a kick higher. But I think there's probably some more downside. My trade today is that I think we're going to go and target 58,000, which is also the lower Bollinger Band. I think we go down to 58,000. I think that's a level that I'd be looking to start accumulating long positions. Anything below 58,000, I think we go below the realised price, and I think that's going to be quite interesting for Bitcoin heads out there. That's what you want to be looking at. But I think the risk is now that we've got a bit of a move down to those 58,000 levels, and that's where I think the short target is.
Awesome. I like it. And remember last week we said it was Bitcoin was half glass full or half glass empty. Looks like you're a half glass empty kind of guy today.
bit. I mean, longer term, I'm pretty bullish on Bitcoin. But yeah, I think in the short term as a trader, just looking at the flows, looking at the ETF flows and these various factors, where's the demand kicking in, it just feels like there's a lack of buyers out there. A lot of people out there, top heavy in terms of supply. So I feel like it's just got a little bit of downside. If you're a hodler, it's nothing to worry about too much. But as a trader, there's a bit of an opportunity there.
Yeah, for traders there are. All right, Chris. Well, thank you very much. My play of the day is going to be the dollar CAD, and you probably remember a few weeks ago we were looking for a break above the 136 level. We broke it. What's more concerning if you're short is that it's not breaking down. And the dollar CAD's been consolidating in what looks like to be some sort of triangle. So what that basically means for me is I'm looking for a little bit of downside, maybe closer to 136.40, 136.50 ahead of the CPI data. I might look to get long, see if I can position myself long ahead of the CPI data. Obviously, if it's strong CPI, the dollar Canadian is going to do well. If it's weak CPI, I'm going to probably get stopped out, hopefully for just a break even, maybe a small loss. I know while it's above 136, 136.10, you don't want to be on the short side. And I think right now it's setting up to make some shorts really nervous. And if you look at the Euro CAD, it looks like it wants to break higher. You look at the Canadian yen, it's not acting very well. Looking at all the yen pairs, the Canadian yen is the worst performer right now. So the Canadian, it's on its back heels a little bit here, Chris. And I think anybody who is long Canadian or short dollar CAD, probably a little nervous at the moment, rightfully so.
Yeah, I was looking at the Euro CAD earlier, and I thought that looks like he wants to break higher as well. I was actually going to put that on the play of the day. So, yeah, good one for pointing out. And it's actually interesting that we haven't talked about the Bank of Japan and the Ministry of Finance today. So maybe that's on the back.
Let's stop and let's we're gonna give you guys a break today.
Anyway, thank you everyone. We can wrap it up. Thanks Blake for your time today, and everyone for watching. Leave your comments as always, as they're great to see, and smash the like button and subscribe where you can. It helps other people find the show. Anyway, we'll see you back next week for more of the Trade Off.